Hey, it's Todd Gehrke. So I've gotten a lot of questions recently about taxes. So what is and what isn't deductible? So origination fees versus points. Technically, a loan origination fee is the fee the lender charges for loan processing. Points involve a loan discount fee. Every point, which is prepaid interest, is equal to 1% of the total loan. For example, if you have a $400,000 mortgage, each point is worth $4,000. For practical purposes, however, the IRS views both origination fees and points as prepaid interest. As per IRS Publication 530, you can deduct these points in the year you purchased the home if you meet several criteria, although you have the option of deducting them over the life of the loan. To qualify for the same year deduction, the home must serve as your primary residence, or you're building a primary residence on the lot. If the property is a second home, you must then deduct origination charges over the life of the loan. You cannot have paid more points than usual in your area. Typically, market buyers pay 2 to 3 points on the loan, not 5 or 6. You can't take the deduction for points if they were paid in lieu of other fees such as property taxes, legal fees, title insurance, and the like. And you can only deduct these costs if you itemize deductions on Form 1040 Schedule A. Now, there are non-deductible closing costs. Aside from origination charges and loan discount fees, the only other deductible items are property taxes and mortgage insurance paid, and occasionally PMI. We'll get to that. Items you cannot deduct include legal fees, title insurance, appraisals, home inspection fees, transfer taxes, real estate commissions, or homeowners association fees. Now, onto the PMI. Is it tax deductible? Well, along with other eligible forms of mortgage insurance premiums, it was tax deductible only through 2017 tax year as an itemized deduction. But with the passage of the Further Consolidated Appropriations Act of 2020 that was signed into law on December 20th of 2019, Congress extended the deduction through December 31st of 2020. That means it's available for the 2019 and 20 tax years and retroactively for 2018 taxes too. The mortgage insurance premium deduction allows you to deduct amounts paid during the tax year or that applied to the tax year if you prepaid, deducting closing costs on taxes. Now, to deduct home closing costs of property taxes, home interest, and points, you must itemize on your Form 1040 return, reporting deductions on Schedule A. Enter the eligible property taxes on line 5C, home mortgage interest and points from Form 1098 on line 8A, home mortgage interest not on Form 1098 on line 8B, and points not on Form 1098 on line 8C. Complete the Schedule A according to its directions by adding these amounts together, entering the total on line 17. It's this line 17 that you'll transfer to line 8 of your 1040. You should file Form 1098 with your tax return to report mortgage interest and points. That's the general gist of how it works. On the property tax deduction, under the Tax Cuts and Jobs Act signed into law on December 22nd of 17, the limits on state and local deductions, including property tax deduction, is $10,000. If your new mortgage is more than $750,000 and you took out the mortgage after December 14th of 2017, you can only deduct the interest up to the first $750,000. For 2018 tax year, the law nearly doubles the standard deduction to $12,000, single filers, and $24,000 for the married filing jointly. They rise to $12,200 for single filers and $24,400 for those married filing jointly for the 2019 tax year. That means fewer people will itemize deductions. If your itemized deductions are less than the standard deductions, you cannot claim them on your federal tax return form. Now, I am no accountant. I'm not a CPA. This is just for your information. Obviously, as always, contact a professional tax consultant to confirm all of the data.